What's up, everyone? This is Anthony Pompliano. Most of you know me as Pomp. You're listening to Off the Chain, simply the best podcast in crypto. Let's kick this thing off. Hunter Horsley is the founder and CEO of Bitwise Asset Management. In this conversation, we discuss his time at Facebook and Instagram. We lay out the case for financial advisors to get exposure to crypto for their clients. We address the common detractions, and we even discuss alien invaders and Mars colonization. I really enjoyed this conversation, and I hope you do as well. All right, guys, bang, 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 bang. I've got Hunter here with us. I'm super excited to have this conversation. I feel like Hunter has been on the front lines of talking to investors about Bitcoin and cryptocurrencies for as long as I have, and been in deep in the weeds. So thanks so much for coming to do this.
100%. I'm so happy to be here with you.
All right. Before we talk about crypto, though, we both worked at Facebook and the Facebook ecosystem or family.
Right.
Let's talk about that. What got you to Instagram? I think is where you started, right?
That's right. Yeah. So came out of the Wharton School, went to Instagram. Worked at Instagram for really a magical moment. There's no substitute for luck. I was there at 70 million in revenue, and I left at a billion in revenue. And they gave me the easy projects, which turned out to be the big projects that we just knew would work. And that was about 300 million in revenue that I got to work on. These are advertising products. It's actually funny, just as an aside, I sometimes get little moments of deja vu because in the early days of Instagram ads, something we would hear from big advertisers, Unilever, Procter & Gamble, was we're not sure that these are real ads. You know, we can't, you know, they're not on magazines, they're not billboards, you know, not TV. I know that you're saying that the numbers look good, but how can we know? So we would get test checks from these giant advertisers for a year just to make sure that the money didn't evaporate.
What is a test check?
A test check, yeah. A test check, depending on the size of the advertiser, could be $1 million or 20 million bucks of ad spend, but not a real allocation of their budget. Because again, it's these ads in an app on the phone, and I'm supposed to take some of my TV budget and put it in an app. I mean, my son, my daughter uses this, but I don't
have an account.
I don't have an account. Yeah, exactly, that type of thing. And at the time, I think. When I joined Instagram, it was 200 million users or something, so it wasn't a billion, you know, and sort of unavoidable like it is today. So, anyways, it's kind of funny how, you know, that pattern of sort of skepticism, despite the evidence that existed in digital ads, is of course something I think both of us see some symmetry with institutional allocators and professional investors as they look at this space. But anyway, so was a product manager working with, as you were, with engineers, data scientists, engineers, designers, etc.
What was your biggest takeaway from working there?
Well, one of them is there's no substitute for just a giant change in the world, right? You know, when you see something like Instagram and you see the numbers doing what they're doing and you see the conversion numbers on ads and the CPCs, you know, it takes a little while for the emotional realities to catch up, for their competitors to realize, for the advertisers to realize. But it takes a while to slow a train. And so if you see a train that's up to speed, that's a really rare and valuable thing. And I think that's also what's so compelling to many people, especially from the tech world, about crypto and Bitcoin. You look at the numbers and you say, this is incredible. This is a phenomenon. I think the second thing, I don't know, you know, just problem solving and, you know, how to professionally, work with a team and hit metrics and you know, just some of the bread and butter like that.
It's the one thing that they're really good at that I don't think people can appreciate, because it's like, oh, Facebook was successful. Of course it was going to be successful, right? Or I saw recently like Balaji and a bunch of folks were debating on Twitter the Instagram acquisition, right? People are like, oh, what are you talking about? Like, how that wasn't a contrarian view? And he was like,
I don't know.
Newsflash, like that was a pretty controversial thing that they did.
I can't even imagine. I wasn't there at the time, but how many users did they have? They had 80 approaching 100 million. They shelled out $1 billion.
They only had 12 employees, no revenue.
Yeah, that's right. It's so extraordinary. I mean, but in hindsight, what an incredible and prescient deal. So, I mean, so you could argue the same thing. Obviously, of YouTube is an easy one to point to. You could argue the same thing of WhatsApp. I think at this point you probably.
But I think that a lot of the like Instagram and Facebook both had very similar DNAs in the sense of like we're just gonna figure it out, right? And like we can look at the data, we can come up with products, like we can test things, like, but we're just gonna figure it out. That I don't think is very common in a lot of companies.
Yes.
But these large technology companies, like that is a common theme throughout them.
Yeah, well said. Well said.
All right, so you're there. You're working with. We're both biased, so like we're just gonna own the bias. The smartest people in the world.
And, smartest, best looking, most charismatic, nicest.
And these massive user bases. Like I always try to explain to people, like when you go to work every day and you're like, wow, there's a billion people touching this product today, right? And we're gonna run a test on 1% of the population.
Right.
And you're like, wait, what's 1% of a billion? What's 1% of a billion? Jesus.
Yeah.
What was like the first time you ever heard of Bitcoin or crypto or blockchain, and like what was your reaction?
Yeah, well, I actually just want to linger on that point, the testing for a second. I do think that's something that sort of you're forced to encounter at a place like Facebook or Instagram that you don't necessarily need to encounter at other institutions. Is after Instagram I worked at Facebook. Facebook 2.5 at the time, it was 1 or 1.5 billion users. Most of your users are not Americans. So
when I was there, 87% were not in America.
Yeah, I think today it's something like 200 million of the 2.5 billion are Americans. So it forces you, in academic institutions, when you read the news, you know that there are different types of people, different societies, different legal jurisdictions. But then at Facebook, you have a small, maybe you're on a team with 20 people, and you're designing for 150 different countries. And 130 different languages, and I think that embeds an understanding of the sort of scale of the internet and the heterogeneity of the people participating. And there again, I think you can sort of see the insane beauty of something like Bitcoin, that you create this standard layer across all of that. Cacophony or all,
and I'll even take a step further. It's more of like a 3D view of the world, and what I mean by that is like a lot of people think, oh, okay, great, you've got to come up with the latest ad product or something, right? And maybe there's some language component or some like cultural component that you got to be cognizant of. But also, like one of the things that I took away was I forget what they called it. You'll probably remember, but there was a place at the Facebook campus that you could go and you could test your product on all sorts of different connectivity environments and devices.
It was called the Connectivity Lab.
Right? Yeah, so it was like, what is it like to have like an Android phone in Indonesia where they have 3G
a tiny little screen. There's all the standards issues. I mean, to get a clean shot where you have a large group of people on the internet all with roughly the same interaction is just so rare.
And you've got to do it. Like I remember one of the big things that we had. So I was running the growth team for Facebook pages, and we had this huge upshot in usage, but it all came from mobile web in less developed countries. So it was mobile basically web. They go to not an application, not on their desktop, but on their phone to Facebook.com. And we had figured out that they were all using phones, kind of like the T9s. So rather, where you have to click a bunch. And so they would try to scroll over, and to get to pages, it was like 3 rows down. We literally just moved it up. So it was less clicks for them to scroll over, and usage shot up.
Those types of things matter.
And you're like, man, that's pretty simple. Like you just made it easier for them to get to it, right? But 100%. It was the numbers, it was understanding the devices, the connectivity, like all these things. And when you start to think that way, it's we're still probably too early in a lot of the crypto applications to look
layers
at some
of friction are immense. If the difference between not having to scroll and having to scroll can make that huge of an impact, then the difference between using MetaMask and not using MetaMask.
Pretty big.
pretty big. Giant thing, So I think that's definitely a present part of the friction in the crypto space, and friction is very real.
For sure. All right, first time you came across crypto, Bitcoin, blockchain.
Yeah. So my journey into crypto, we actually had the opportunity, myself, my business partner, co-founder and starting Bitwise, a guy named Hong Kim, did software security in the Korean military. Worked at Google, knew him from University of Pennsylvania. We're close friends, and we actually had this rare opportunity to some investors offered us money to quit our jobs and just prototype something, just to work on something.
Was this the Google / Twitter / Facebook mafia?
It was they were both ex Google. It was Vichal Garg and Elad Gil.
Can we talk about the angel investor mafia that's going on there? So for those that don't know, there's each technology company in general, it's an overgeneralization, but they all have a group of folks who have a bent towards angel investing, towards early stage technology, and they are notorious for finding usually younger talent at the company that they don't think is going to stay and be a lifer, and either one saying, here's some money, go figure something out, or people know who they are and go and pitch them and say, hey, I'm going to leave and go do this. Would you like to invest? Yeah. They've been fantastic investors over the years because they've got great talent very early, like all the ingredients you need to be a good angel investor. And so they came to you guys and basically said, here's some capital.
Yeah, I mean, there's a bit of a longer story to it. I don't want to use up too much of our time. This is going to be a Facebook retrospective podcast, which is fine by me. But the short of it, so I left and Hong and I raised some money, and then we were working out of a living room, putting our heads together and prototyping different concepts. If you're two software people in San Francisco at the beginning of 2017, before too long, someone says, hey, do you remember that Bitcoin thing? Yep. And I was like, gosh, I think I bought some on some website at some point. And of course, that website was Coinbase.com. I don't know if you've heard of it. It's popular.
I'll look it up.
It's like Gemini. I bought some at some point in 2013 or 2014 and I'd totally forgotten about it. And it was actually a friend from Wharton who was working at a StatArb hedge fund. And he said, hey, they're 40% spreads in markets on this stuff. And we were just like, that doesn't seem right. Mm-hmm. So our journey into crypto was we started out by arbitrage trading. And that's not what we're doing today. But I think that everyone sort of has that one project or experience that gives them pause to look at it more seriously and for a more concerted amount of time. And that was what it was for us in February or April or March, that time frame. We started arbitrage trading, and that gave us the opportunity to learn about different protocols, meet some people who are building blockchains, deal with the ecosystem of trying to buy different assets. If you remember at that time, I think Coinbase was only brokering Bitcoin and Ethereum, I think. And also to think about why would we root for this? Mm-hmm. I think when you work in crypto for long enough, you forget that at the outset, it's not obvious to everyone if this is like the team you want to root for. Like de novo, it doesn't necessarily sound like something. It sounds complicated. It sounds like it's going to complicate everyone's life. Mm-hmm. Like your mom's now going to have to deal with not just cash, credit, and her portfolio, but now there's this whole nother set of things she's going to have to deal with. Is that something you want to root for? And so. So give us the moment to think about that. And where we landed was thinking that this could be one of those trains that's hard to slow down, mm-hmm. and could be one of the most important breakthroughs or pieces of progress in technology over the next decade or the next 2 decades. And we just felt like we'd love to contribute something to this. We'd love to be part of this. This feels like the type of thing that's going to get a chapter in the history textbook. Mm-hmm. There are other things that we worked on, insurance for cybersecurity incidents, which is a growing industry and a great opportunity. Concepts obviously having come from Facebook and Instagram, concepts around entertainment experiences, social media. Mm-hmm. But then I think we just looked at this and said, wait a minute, this is not only is there opportunity here to create services that are valuable and build a business in doing that, but also maybe this is going to change the world a little bit. So,
well, it goes back to the idea you can bet on products, you can bet on teams, or you can bet on markets. Right. And when you bet on the right market, the market can carry you pretty far. Yeah. Even if you mess a lot of stuff up, if you bet on the right market at the right time, you're going to be in good hands.
Yeah. Andy Ratcliffe, the founder of Benchmark Capital and CEO of Wealthfront, has a great quote that goes something like. Bad team, good market, market wins. Good team, bad market, market wins. I do think there's something to that. So to close the loop, so there we are feeling like, wow, this is this really exciting thing playing out right in front of us, and we have time, to be building things. And we were talking to people about crypto, and a common refrain that we heard in March or April of 2017 from people who are executives in tech, people who are in financial services. They have investable money. They're tech savvy. They're financially competent. They're confident in making their own decisions. We heard I'd like to invest in this crypto thing, but I don't have time to figure it all out and to be constantly monitoring it, and I'm not sure which one I'm supposed to buy. And we heard this enough time from people like that. Again, this is not like your uncle who, and I don't know your uncle, so no, I hope your uncle doesn't take offense. He might fit the bill here. But these are people you would expect to be on the sort of upper tiers of ability to figure out.
Yeah, they're folks who are normally in technology,
Yes.
who understand user experiences.
Yes,
They can deal with some friction.
Exactly.
Yeah.
And the common friend was, I'd like to participate. I just am not going to spend. If I looked at it's too complicated. And so we said, wow, we're hearing this, and we realized that there is, from our perspective, a piece of market infrastructure that was missing. Mm-hmm. At that point in time, you had, and even still today, and this might frame up a little bit how we think about what Bitwise is trying to contribute. You had on sort of one end of the spectrum for enthusiasts who wanted to trade it throughout the day, or who wanted to pick specific assets or participate in ICOs. You had great tooling being built out. You had you could download Coinbase. You could get more involved with Kraken, where you could even take margin. You could do esoterics. You could hold it on a ledger or Trezor. You could do research on Chain FX. And so you had an emerging ecosystem for the person who was excited to spend the time. On the other end of the spectrum, for very wealthy families, some of them knew a guy who was just spinning up a hedge fund. Like one of their friends just decided to go ahead and spin up a fund. But in between, you had most of the rest of the people who were like, I'm interested enough to consider something. I'm not interested enough to decide between the following apps, the following coins, to upload a driver's license, to request a withdrawal increase. And I also, what we realized was missing is the ability for their financial advisor and for them to use a conventional mutual fund, ETF, interval fund, what have you.
Yep.
And so we said
and
there's opportunity there.
Is it really? And as I previously mentioned in the introduction, right? We're obviously investors at Bitwise. We're huge fans of what you guys are doing. And the way I think about it is, it's an access component.
That's
right? It's I've got to do some education. I've got to learn in terms of how do I think about this in my portfolio? Why would I get exposure? Right. How do I size it? All that kind of stuff. But then once I've made that decision, that's where all the questions come in, right? And this is something that looks like, smells like, acts like exactly how I get exposure to other assets. And therefore, I'm comfortable because I'm already taking, quote unquote, risk by going into something new, right? I don't want to take risk by going into something new, plus going into a new type of vehicle, plus having to sign up for a new account. Like all of that stuff just compounds and makes it harder and harder to get there. I think really when I look at what you guys are doing, it's just how do we break down the frictions to access and make it look and smell just like everything else that you do.
That's right.
Right.
That's exactly right. We think of ourselves as an infrastructure company, or as for my tech friends, I would say we're like an API company. But the API is so important that we put it into a legal structure and call it a fund.
Yep.
We're trying to empower people to lean on the same financial professionals that they use to manage investment grade bonds, emerging markets, commodities, natural resources, high yield debt, et cetera, and to be able to go to them and say, I think that I want to do something here. And they say, okay, no problem.
Yeah, so I want to get into kind of like the argument for crypto in somebody's portfolio. But before I do that, give us an update, just any metrics or kind of milestones you can share from
absolutely.
Bitwise itself to give us a sense of kind of where you guys are.
Yeah, absolutely. So Bitwise today, we're about 20 people based out in San Francisco. We're boutique. All we do is index funds and access products for particularly today, financial advisors, multifamily offices. We meet with some endowments and others, but the conventional people are most interested in those types of products. And then we do a huge amount of education work. I mentioned to you before, we do about 2,000 conversations with advisors a month between events, phone calls, et cetera. We never disclose, or historically we haven't disclosed the assets in the fund, but I can tell you that we've had inflows every week for the last 2 years.
P.S. for those listening at home, that's good.
I can tell you that additional subscriptions are well in excess of redemptions. I think that we've seen in the life of the fund something like 7% of investors redeemed from 2017 to today. And to our knowledge, it's the largest public index fund in crypto today.
Awesome.
So that's a little about the firm. You're very familiar with our firm. If there are listeners who aren't familiar with us, the other thing that I usually like to mention is that we've tried to assemble a group of people who straddle backgrounds in software and traditional asset management. So we started this conversation talking about our backgrounds in tech, and obviously your partner Mark Yusko marries that with a background in asset management and asset allocation. For us, we today have brought on a number of veterans of the ETF space. Matt Haugen, our head of research, 15 years, is one of the foremost experts on ETFs. Co-authored the CFA exams book on ETFs. Teddy Vassar, our COO, was former senior vice president, head of portfolio management at New York Life Investments, which is a giant conservative shop. Before that, at Index IQ, which did liquid alternatives. Before that, Direction. Mick, our head of distribution, 10 years at iShares from 2001 to 2011. Russell Investments, and then most recently was the head of distribution for Deutsche Bank's ETF business. Grew that from 70 million to 20 billion in assets. So I think that for our clients, and when people think of the firm, what we hope that they think of is a professional group that can straddle those two perspectives, and a partner for building their understanding and then deciding how they want to play it. Yep. And also, some people don't end up playing it through our vehicles. Some people talk to us to build that understanding and end up investing through venture vehicles, which is, I would say, one of the very popular approaches today. So that's a little about the firm, but yeah, focused on advisors, have those market access vehicles, spend a huge amount of time on education. Matt actually jokes that we're an education company that happens to have index funds, and then the other thing we're known for is this ETF filing. But
so we'll get to the ETF filing in a second.
Great.
But I want to do. You've spent hours and hours and hours going and talking to RIAs, wealthy family offices, etc.
Yeah.
And we are not giving investment advice here, but I basically want to give people kind of a peek behind the curtain, because most people listening to this are not going to be part of those conversations. And so help me understand kind of like what's the argument, or what is the education that's happening kind of in those, like, I think of it as kind of like intellectual hand-to-hand combat, where you're walking into a room, whether it's a meeting with like an RIA and a team, or it could be walking into like a lunch or a dinner with their clients, etc. What does that look like?
I want to tell you the sort of the three things that are motivating advisors to come into the space. And it might be fun to talk about some of the common questions that we get. I know that you get as well. Before even doing that, for a second, I want to sketch out who is this advisor person. If they're advisors listening to the podcast, we love you and you know what you do. But believe it or not, in crypto, I think very few people are actually familiar with financial advisors. And I actually tell you might get a kick out of this. There's a number of venture firms invested in our company, and you'd be surprised by the number of venture firms who aren't aware of financial advisors. So with that having been said, I want to, before I describe how they think about the space, I just want to describe who they are. So if you sort of draw out the landscape of cohorts that are investing in crypto today, I think by and large you can map them into four buckets. The first is self-directed individual accounts. So these are people who are investing their own money, making their own decisions. They might have bought Lyft's IPO through their Robinhood account because they like Lyft and they heard good things. They trust themselves with their money. They're nimble. These are the first movers into crypto. So, some people call them retail. Yep. But it's also you and me. Like, it's people everyone does this in some amount. That audience in the US controls 3 to 4 trillion in assets. And by and large, they use Coinbase, Gemini. If they get more involved, it's Kraken. Yeah, exactly. They might use a ledger. They might do research on CoinMarketCap. Then you have financial advisors, who I'll come back to. Then you have institutional asset owners, the pensions, endowments, and foundations. They manage 24 trillion in the U.S. That's 600 billion with the endowments, 800 billion with the foundations, and 22 trillion with pensions, which are giant. And Morgan Creek Digital is famous for having the first partnership with a pension that had the courage to publicly undertake adding this to the portfolio. That audience tends to prefer active managers, is happy to take the illiquidity in many cases. And today they work with a lot of venture managers like Morgan Creek Digital, like Andreessen, like Paradigm, Electric, etc. Then one over you have so 24 trillion there. One over you have the institutional asset managers. So there would be like you would think of like DRW or but DRW is actually a different beast, so we'll set that aside.
Blackstone.
Yeah, exactly. And those people, by and large, today are not yet in the space. Okay, so those are different cohorts, and the reason I say that is because I think sometimes in crypto, when we talk about investors, depending on who you're imagining, you intuit differently how they'll react to something, what might be on their mind, what else this might be trading off against, and what solutions they're looking for. So we have the self-directed guy, first into crypto. We have the institutional asset owner, which we talked about, and you can add sovereign wealth funds and insurance companies and hospital systems, et cetera, to that. In between, the financial advisor manages $22 trillion in the U.S. On behalf of individuals, wealthy families, and high net worth individuals. And that can be anything from a Wells Fargo advisor that's down the block or JP Morgan private banker. But a huge portion of it is also what we would call RAs or independents. Mark Zuckerberg famously works with Iconic out in San Francisco. The Rockefeller family works with a firm in New York called Rockefeller Capital Management. Those are advisors or multifamily offices. And what they're doing with their clients is, in some ways, the same way you work with a physician on your health, you work with this financial advisor on your money, which is, I think for everyone, 3 priorities are their family, their health, their money. And so many people choose to work with a professional on their money, and that's the financial advisor. And the financial advisor is helping you think about what are your cash needs this year? Do you have retirement goals? Is somebody going to college? You're going to have to support aging parents. And then they're orienting the investments you make around those liquidity time horizons, et cetera. And so that is just the frame that I want to set for describing the conversations we have with those people. But what we are working to do, that audience generally doesn't use venture funds, and they're definitely not using apps. It has to go through their existing workflows, their infrastructure, and that tends to be ETFs, mutual funds, and then a whole set of workflow. So we're working to build a bridge to that audience. It's a giant audience, and from my perspective, also, crypto cannot be successful as an asset class if mainstream people can't rely on that financial professional to handle it for them. I think it's a beautiful thing that individuals like ourselves have the enthusiasm to create accounts, to make investment decisions on our own, to interpret the volatility. But I do think that enthusiasm has a half-life. And we even see this sometimes, people who invested some money in 16, 17, 18, getting a little worn out and exhausted, something else in life becomes busy, and then they ask their advisor to handle it for them. The same way the advisor, again, handles the options they have from some tech company, the high yield debt, the private credit, everything else. And they say, can you handle this? So that's the audience we're focused on. That audience has a lot of clients. They're very busy. They're thinking about everything. They're thinking about equities, up 20% plus this year, gold up 18%. They're thinking about, we're 10 years plus into an expansion. They've been worried for the last 3 years that the party's over and, we need to start to get defensive, but you can't come out of risk assets because then you miss the 20% return on equities this year and your client is, confused. So that's all swirling in the backdrop, and it's a very busy time for the advisor. And then we come along and say, we'd love to be helpful and talk to you about crypto if that's something that you're interested in. So that's where they're starting. There's a huge setup to your initial question, which is what is the case for them? There's 3 reasons that advisors think about crypto today. The first is in relation to sort of what I just described, their client's doing it, and they work for the client. We do a survey every year. We commission a survey that's a benchmarking survey on advisor attitudes and decisions around crypto. We'll have a new one coming out in January. Last year's survey, advisors reported 1/3 of advisors said that their clients were investing in crypto without them, without their oversight. Another third said that they don't know. So the first reason, and there's 3 components to what advisors are thinking about, but the first reason that advisors are thinking about crypto is because their clients are doing it, and they're there to help their clients.
Their clients are pulling them into it.
They're pulling them into it. And also what can sometimes happen is the client gets in trouble, like they get SIM ported, or they get locked out, they forget their password, or they get busy and they say to the advisor, can you deal with it for me? Or they have to pay taxes. And they say to the advisor, can you pay taxes? And then the advisor says, oh my gosh, what is this? When did you buy it? What was the cost basis? How did you decide this? Do you want to keep it? Do you not want to keep it? All these things. So advisors are incrementally, month after month, getting pulled into it because of their clients. And they want to protect the client. They want the client to achieve their financial goals. They want their clients to pay their taxes. They don't want their clients to get hacked, lose their passwords, etc. I was chatting with this one advisor who was telling this funny story about his client said, hey, I'm going to buy some, this is a very wealthy client. I'm going to buy $10 million of this Bitcoin thing. I just downloaded the Coinbase app, but I'm kind of confused. Can you help me? And so he sent his password to the Coinbase app to the advisor. And then the advisor's in the Coinbase app trying to like get the withdrawal limits pushed up so you can wire 10 million. So this sort of like
newsflash for those that don't have $10 million and trying to get it on Coinbase. Coinbase will not let you put $10 million on the app.
That'll be difficult. Or just one other case is another client who she had $400,000 in Bitcoin and she did get simported. So her phone got hacked. She lost control of her Coinbase account. And then she asked her advisor for help. So the first reason that advisors are looking at crypto is because they serve the client, and the client, there's 40 million Coinbase accounts. Like the client is doing it already. And they want to know, okay, how can I, if they're going to do it, I want to support them doing it. How can I do that in a sustainable, no risk? It's hard for them to discern the difference. Coinbase is an incredible service. In their minds, Coinbase and Quadra CX are like the same thing. And so they're like, I just don't know which of these things. So they want to help. They want it to be sustainable. They want it to be secure, and they're dealing with a lot of complexity. It's not their expertise, and they don't have time because they're also dealing with the equities and figuring out fixed income and figuring out 2020. First reason. Second reason is what I think you read about. It's more theoretical, more academic, which is just objectively what it can do in a portfolio. You do a portfolio analysis. It does very compelling things. So.
And this is the argument for non-correlated asymmetric assets, blah, blah, blah.
That's exactly right. So we have a study, and others have done studies. If you do a 1% allocation into the Bitwise 10, the BitX, over the life of the index, and you rebalance it into a 60-40 portfolio, so a very standard portfolio, you do 1% allocation, it added 1.3% to the annual return of the portfolio, and it reduced the volatility.
It's funny how like modern portfolio theory works, huh?
Right. So people are surprised by that, and so I think some people look at that and say, wait a minute, this can help me accomplish my goals. I'm sure that this is what's going through the pension's mind. It's not that they picked a team; they're not rooting for something. They're saying we have a funding goal. We have something we're trying to accomplish with this portfolio, and I'm looking at the math, and what I'm seeing here is that I can take minimal risk. I can even diversify some of the portfolio. And I have reason to believe that there's upside here. So the second reason is that I'll append to that for financial advisors specifically, there's this thing looming in the background. And the thing looming in the background is markets are in a very weird place right now, more generally. This year, actually I think just a month or 2 months ago, Morgan Stanley came out and said they think that 60-40 is basically dead as a standard asset allocation.
Why?
Their view is that assets are way overpriced, and that correlations are going to conventionally bonds are negatively correlated with equities. That hasn't always been the case. That wasn't always the case in the 20th century. That was mostly the case in the last 30 years of the 20th century. They predict that over the next 10 years, a 60-40 portfolio will return 2.8%. That contrasts with the historical average of the last 100 years is 8%. So what they're saying is this time it's different. Something has changed. We could discuss what might have changed: asset prices, the injection of capital through quantitative easing and other measures. But Morgan Stanley saying this. Bank of America came out and said this. GMO, which is a macro analyst firm, expects negative returns from U.S. large cap equities as well as U.S. bonds over the next 7 years. You've probably read the pieces by Ray Dalio this year.
Ray Dalio is a Bitcoiner and doesn't even realize it yet.
It is really, sometimes you read that stuff and you think, gosh, well said.
Yeah.
But a statement in his most recent, I think it was from November, 6,000 words on LinkedIn. God bless him for publishing on LinkedIn, especially given how difficult it is traditionally to get Bridgewater research. He says something to the effect of, you can't rely on cash and bonds as a safe store of value for your money. So the advisor is thinking about all these things. And what a lot of them are seeking to do in response is, you can't hide in cash for a few reasons. you just heard the case that you can't hide in bonds, and yields are not attractive anyways, and there's anxiety about inflation in high yield. So what do? Alternatives is what a lot of people are looking to, particularly in the advisor community. It's in that context that crypto becomes a solution to a much bigger problem that advisors have right now, which is, okay, so I'm naive. I'm going to look silly if I just stick 60-40 for the next 3 years, despite all of these credible sources telling me that that is not a legitimate strategy for what's coming. But what are my options? You look at alternatives, and in that consideration set, crypto is this magical thing. You don't have to reallocate your entire U.S. equities portfolio. You don't have to diligence specific venture firms. You can simply take a 1% exposure, get off zero, as some people say. I can't remember who came up with that, but they're deeply influential. And introduce these favorable things to the portfolio. Demonstrate to the client that you're doing something, and it's liquid. It's liquid. So that's the second.
And do you feel like the advisors, as they're thinking through those three reasons for crypto, they're further ahead than the clients, or the clients are further ahead than the advisor, right? Like, where do you see the enthusiasm?
The client has done more action, and the advisor's done more thinking.
Okay. Interesting.
So the client heard that XRP is the next big thing, or that Ethereum is the next big thing. This, of course, I'm generalizing. So this is not always the case. So very sophisticated individuals directing their own portfolios and accounts. But I think the advisors have approached this from a position of, oh, whoa, different counterparties. It's moving, a lot in short periods of time.
And do you find that the advisors are, hey, okay, I get this. I think I should have my clients have exposure to this. Let's start with like 10 basis points. Let's go to 500. Like, how do they think about? I've gotten over the hump of whether I should do it or not. Now I've got to think about sizing it up.
Yeah. It depends a lot on the advisor, but it also depends a lot on the client. So what we usually see actually is the firms that we work with, they have 1 to 5 clients that they know are the ones that are investing in crypto, who have the right risk appetite, and from there it's like 25 to 1.5 basis points. There are a few who are very either the client is very passionate about it, but we don't see. I think 1 to 2.5. We don't see much outside of that. The third thing I want to mention. So advisors. I have a million things to say about Advisors Pomp. The first thing, but this is what we do all the time. 2,000
I love it. I'm here to learn.
We're traveling around the country, doing that today. The first thing is that they're responding to the client comes to them and says, taxes, lost my password, trying to buy it on Coinbase, not being successful.
I'm going to pull you in.
So they pull them in. The second is they're looking at the numbers and they're going, I got to do something about the asset allocation I've got here, but I'm not sure what to do. If I go into cash, again, I'm going to miss the returns. And then, my clients can ask me, why is my portfolio not returning as well? If I go into alternatives, this is a pretty, uncharted territory, and I'm going to have to deploy into things that maybe aren't liquid. And, small sizes, I can do interesting things for portfolios. And so that's the second thing. The third thing for advisors is advisors care about attracting new clients by demonstrating, particularly for the independent advisors, things that they can do that the old guard can't. So if you're an independent, you're trying to win clients from UBS. All the people who are turning their nose up at crypto are your competitors for winning new advisory clients.
It differentiates the RIA from the RIA down the street.
Yes, exactly. From the wirehouse in particular, from the Wells Fargo, UBS, Bank of America, and at some of these firms, the advisors at those firms want to do it. Their just hands are tied by the much larger institutions. So the independents, the reason that they generally went independent was to be more nimble, to be able to serve the needs of the client in a more bespoke way, and to be more progressive in what they could offer, and not have to conform to JP Morgan wants you to distribute JP Morgan funds to JP Morgan advisory clients. And so the third is business considerations. They want to win clients. The other aspect of that is they want to retain the next generation of their aging clients, and the next generation is a millennial, and the millennial is almost more bullish on crypto than they are on T-bills.
I see two groups that are pulling those advisors in. The first is I'm a young, I'll put in air quotes, self-made, because I don't even know what that means anymore in this world.
Yeah.
But there's somebody who has become wealthy without inheriting the wealth, right? And they're usually on the younger side, and so they're into this stuff, and they're pulling their advisor in. The second is what the situation you're describing, which is somebody else made the wealth. The person now is inheriting it.
Yes, that's right. Yeah.
And hey, my family made all their money in real estate. I want to do something else. I want to make my own name, right? Or I'm personally interested in this. I want to divert some funds. My grandfather died, so he's no longer around. He would buy Bitcoin if he was here, right? That type of stuff. And it feels like the common thread through both of those is that these clients are usually on the younger side, more so than the 60-year-old client who's retired and quite wealthy, but they're still pretty much asking a lot of the questions we'll get into, and I don't see them jumping in as much as maybe the younger people.
I think in general, at this point, well trodden thing, but millennials tend to be the driving force. The millennials stay 23 to 38, something like that.
23 to 38. Wow. Yeah. That's a big gap.
It's a wide window, and it's about, so.
All right. So let's go through. I want to play a game of, I'm going to throw out detractions that I've heard in a lot of these rooms. Some of them
I've never heard a single detraction about crypto.
RIAs,
so all these surprises to me.
And some come from the endowment world.
Yeah.
But I think you and I have spent a lot of time doing the same thing of just get people in a room.
Yeah.
Here's the kind of the case for this. Ask me your questions.
Yeah.
Right. The first one is security and custody.
Yeah.
So I heard that somebody stole somebody else's Bitcoin. Why would I buy Bitcoin or other crypto if it can get stolen from me?
Right.
Well, how do you think about that?
Yeah. So I mean, so this comes up quite a bit, and oftentimes people will point to a story like QuadraCX. Literally today in one of our sessions, QuadraCX was brought up. This some Canadian exchange getting hacked, or somebody lost their USB and lost their funds.
My favorite has been the guy in Korea. Right? I was like, what? The guy in Korea. And I had to ask him, in North Korea or South Korea?
Yeah. So I think the beautiful thing about crypto, for much of your audience is you have the option to hold these things yourselves. I think to the advisor, you say, this is one of the ways in which you can add value. You, the advisor, is helping your client parse the landscape of different ways to hold this exposure, from the exchanges to the brokerage apps to the venture funds to the today the sort of enterprise grade institutional custodians like Fidelity, BitGo. I gotta give shout outs to all my favorite custodians now, don't I?
They're all in there. They're all in there.
Anchorage, custody. Yeah. I mean, there's tons of great custodians. They're all super sharp. But to many, taking a step back, many professional allocators, they're operating off of a snapshot of the world that they took in November of 2017. And in November of 2017, there was basically Kingdom Trust, which they hadn't heard of. Kingdom Trust, pioneer for the industry, great firm, but they hadn't heard of it. And so all they really knew of is people holding things on USBs and on these apps. They're not aware that today you can hold it in an insured, regulated custodian, and that they'll hold it offline and they won't even put it into a trading environment. And so there, I think the point that we make is just that for many clients, it makes sense to work with an industrial custodian like that.
A lot of people will argue it's so volatile, right? It went down a bunch recently, right? They won't exactly know the price movements to a T, but just it's really volatile, and a bunch of people lost money, or somebody I know lost money.
Yeah.
Thoughts?
Yeah. How about that? I like your thoughts. Volatility isn't in of itself an indication that something is a bad investment. You have to ask yourself, why is the volatility happening, and what does the volatility mean for me? The volatility is happening because people don't agree on the value of these assets, and it's a very nascent, controversial space. The analogy we like to give is, people often compare Bitcoin to gold. We wrote about this over the summer. I think the apt comparison is Bitcoin to gold, but not gold of today, but gold of the 1970s. When the Bretton Woods system ended and the US dollar came off gold as a backing for international redemptions, it was unclear to the investment community if gold would stick around. Keynes called it a barbarous relic. Maybe it was time that we would shed this piece of antiquated monetary history and just move on from it. And so there was a period in the 70s where there's a lot of volatility because some people said, no, this is 1,000 years of a track record of being valuable. This is an independent, store of value. And other people said, no, this is worthless metal. And now it's not even being used to back the dollar. And in the 1970s, there was a year where gold was up 120%. There was another year where it was down 30%. It ended the 70s up 1,300%. Mm-hmm. After the 70s, those discussions, those arguments were had. The volatility played out. People, expressed their points of views in the market, created the volatility, and we landed on the understanding of gold that we have today. And since then, gold returns on average, something between 1% and 2% a year. So the volatility in crypto, I think, is similar. It's that people are working through, what is this thing? What is the value of this thing? Is it here to stay? And that's causing the price to move. The volatility is moving in one direction. Over the last 10 years, the average daily volatility of Bitcoin has come from 10% to around 3%. So we are forming a tighter band of consensus. The other point I make about volatility, which we talked about a bit earlier, is if viewed in the portfolio context, it's a real boon. What's important is that it's being volatile in different moments than your equities are and that your fixed income is. And as a result of that, as mentioned before, 1% allocation rebalanced quarterly of the Bitwise 10 reduced the volatility despite the volatility of crypto, reduced the volatility of the portfolio.
So this is a really important point because I think a lot of people who aren't well versed in finance or just haven't spent the time to kind of learn about this. Modern portfolio theory, there's a really big importance on non-correlation and on if you put a lot of assets into a basket that have the non-correlation or are all volatile at different times, you actually are diversifying the risk, right? So the idea that, hey, I take this hyper volatile thing and I put it into my portfolio, well, the odds that you have a bunch of other things in your portfolio that are all hyper volatile and are driven by the same value drivers is very low.
That's right. That's right.
And that's where you get the correlations. And then obviously, my favorite example is in May of 2019, when the trade wars are all raging on. Right. I mean, literally, the world leaders are tweeting at each other, all this crazy stuff, right? There's a lot of political and geo uncertainty. Yeah. The Bitcoin correlation to stocks and gold went negative.
Oh, interesting.
So it went negative 0.9 to the S&P, negative 0.8 to gold, and it was up 55%.
Wow.
And so it was this weird situation where we talk about non-correlation, but it actually went the opposite, right? It went to the negative correlation. So when you see those moments, it goes back to this idea of like the insurance, the SMUC insurance, or the chaos hedge, right? All these kind of things that I think in the crypto community now have become more accepted. Advisors have never even heard of this stuff yet, right? And I think that's some of the work you guys are doing is trying to get them to understand that.
Of course, yeah. And so to your point, in those moments, that's really valuable to have that negative correlation. And the other thing about volatility, I have a million thoughts on everything, but the last thought on this is obviously we feel this way because we serve advisors. Those are our clients principally. But it's also one of the reasons that it's so valuable to have advisors managing this for clients. If you open I have the Coinbase app. I'm sure you have the Coinbase app. You open the first thing we'll see is the price, the 24-hour price chart of the movement of the price. People are not well matched against daily price volatility. They don't know what to expect. It is emotionally scary.
2% drop looks big on a 24-hour chart.
Yeah. That's exactly right. Yeah. So I think the other implication of the volatility is advisors can really add some value, some very basic value, which is just to insulate their clients from bad trading behavior. In the same way that if they were day trading their Netflix position, they probably would have a suboptimal return for the year because they sold at a bad moment. And so I think volatility is really essential to the asset class. I think it doesn't intrinsically make it a bad thing. In fact, because of correlations, it's a good thing for portfolios, but it's also a reason that advisors can add a lot of value.
The government won't let this happen. They're going to lose power, and regulators or the law enforcement, somebody's going to step in and shut all this nonsense down. Yeah.
Well, I mean, so I think there again, we live in a sort of a very different world in 2019 than we did in 2017. So if the mental model people have is that regulators or the government are sort of a parent who heard a loud noise in their kid's bedroom in 2017. They started walking towards the door. At the beginning of 2018, they opened the door and they saw the mess. And the SEC subpoenaed everyone, and the 25 charges. And but today, where we are in 2019, so that's happened across. Of course, there's lots of different regulators in different places. But FinCEN, NYDFS, the SEC, the CFTC, even this summer Congress through the lens of Libra, are all staring it in the face. They know it's happening. Obviously, the SEC set up FinHub, the CFTC set up Lab CFTC. So I think that regulation today is in a dialogue with the industry, and sometimes the industry is happy with the progress it's made. Sometimes they wish it would go faster, and that's a natural tension between private sector and regulators. But I think that sometimes the concern that the intuition that as soon as the regulator walks in the room, they're going to be livid and everyone's going to jail is just not the state of affairs in 2019. We met with the SEC 8 times over the course of this past year. And I think, for many others, this is ongoing dialogue. So I think that is in a really good place. And that's really important for people who want to participate as investors as well.
Crypto is just speculative assets that has no real value to it and no one's using it.
Yeah. So on the using it front, I think that the analogy I like to give is, so first of all, a lot of people are, again, we're talking about mainly people who are not working full-time in the industry. So for the listeners who work full-time in the industry, we're not talking about you. I think for many others, for individuals, families, institutions, advisors, as silly as it sounds, it's called currency. So you start from, okay, well, if it's currency, show me how it's being used like currency. And this manifests itself in, I'm not buying coffee with it. And the reality is, I don't think that Bakkt is going to work with Starbucks to make that possible, but that's not the most important thing. And the mental model that I would suggest for looking for use cases is not what are all the places where it's not better than the US dollar today, but rather there just needs to be one thing that it's good at. And here's the analogy. In 2007, everyone's using laptops and desktops, and along comes the iPhone, a new computing platform. It's not the case that the iPhone replaced all desktops and laptops. We still use desktops and laptops for spreadsheets. I pity the individual who's doing spreadsheets on mobile. For PowerPoints,
writing, a bunch of stuff,
writing, email. Mobile, there's some other things that are just way better on mobile. Maps, Uber, taking photos wherever you are. And you do email on both. And I think similarly, when we think about public blockchains, the heuristic we should have is not, has it wiped out all other payment systems, all other currencies, has it replaced everything? It doesn't have to. It's going to coexist, just like the iPhone coexists with your laptop. It just needs to find its Google Maps. It needs to have the one thing that, oh my gosh, is so much better. And there I think we see burgeoning examples. Specifically, the most obvious one is people using it to transport money across borders. That could be, fleeing inflation in Venezuela. There was that great op-ed in the New York Times, this Venezuelan economist who talked. The headline is, and you can look it up, "Bitcoin saved my family," and he's talking about moving out of 1,000,000% annualized inflation is going to destroy his family's savings. That's very real. So being able to get, but also if you just this. I think 2 weeks ago, $500 million was moved across the Bitcoin blockchain for $36 or something, a de minimis fee. So I think the thing it's doing a really great job at is, you're not buying coffee. You're not at the register. Every second counts. You're happy to wait 10 minutes.
Well, and people forget too. You're not using dollars to buy coffee usually.
Right. You're using credit. Yeah.
This is one of the things that we go pretty deep with people and just say, listen, it feels like dollars.
Yeah.
Right. It's denominated in dollars.
Yeah.
It's a great user experience, but don't forget that you actually are paying it off at the end of the month.
Right.
That's a pretty long settlement timeline.
Yeah,
for
right.
That
That's a great point. Yeah.
And now there's great advantages as to why to do it. There's a very, very good argument as to the impact, the positive impact it's had on society, etc.
Yeah.
But you are actually not using dollars in that scenario.
There you go. That is a perfect example. So to the use cases, I say first, as investors, I'm worried that we'll miss the boat if we wait for coffee. What we need to see is just a great use case for a or multiple public blockchains. And I think the leading candidate today is some version of, you call it remittance, capital expatriation. There are 260 million people who change the country they live in each year around the world. If you're moving your family from, I don't know, I'm going to say Indonesia to Spain. Oh my gosh, is there any moment where you could simplify that? Or if of course, there's a giant remittance corridor between the U.S. and the Philippines. Is it easier to send some money that way? Is it easier if your limit on Venmo is $2,000 and you have a friend or you have a kid in college? Is it easier to send him $5,000 some other way? So,
and most of those platforms, a lot of people don't know this, but Venmo, Apple Pay, PayPal, they're not available in these other markets.
Oh, that's also a very good point. Yeah.
Right. So it's in the U.S. we sit and we say, hey, I'll just Venmo you. Right. But I forget, we did the analysis and it's like the countries that it's not available in would shock you.
Really?
Right.
Oh, wow,
because it's just, now they have something else.
Yeah.
Right. But Venmo can't get sent to, M-Pesa. Right. For example, like those two don't, they're not compatible with each other.
Yeah.
Whereas when you look at something like a Bitcoin, right now you've got something that is globally available as long as you have an internet connection, which I think is really important as well.
Yes, absolutely. Right. So that's how we think about what even to be looking for is the heuristic for progress. And it is important that people are looking to see progress. Mm-hmm. You can't just close your eyes. But I think it's important that you're being realistic about what success looks like, and I think it's seeing 1, 2, 3 of those use cases, and I think we're seeing those today. Yeah.
Okay, fine. You convinced me people use it, but they're just terrorists, drug dealers, and bad people.
This is simple. So I mean, the two things there. First of all, the DEA said, I believe this year, that less than 10% of activity on blockchains is today illicit activity. It's fair to point out that is a part of the origin story of crypto, and in the Silk Road and that history, but just take the DAO's word for it. So and then I think that the second thing that we point out, depending on the interest level of the audience, is depending on the blockchain you're using, it's pretty trackable. And so I think what a lot of central banks and governments are coming around to, and one of the reasons people are excited to sort of sprint into central bank digital currencies is, oh, wait a minute. We don't have to deal with cash. We can give people the flexibility of cash, the bearer instrument that they can exchange wherever they want, whenever they want, with whoever they want, but we can track it. We can't track the $100 bill.
The choice currency of the drug dealers is still physical cash.
Right. So if you said to a regulator, you don't have to restrain any of those use cases, but you can witness them all. You can surveil them all. Then I think the regulator feels good about that. So I think increasingly this notion that you can hide nefarious transactions through the Bitcoin blockchain, say, or another, with the exception of the ones that are specifically trying to facilitate that, will fall away, and people will realize it's not the best way to do that. And it's a permanent ledger, so they don't have to get you this year. They don't have to get you next year. They'll get you in 10 years. So that one, I say relevant consideration. There are AML requirements in place for interacting with the regulated part of the ecosystem. If you work with a counterparty like us or like you, they're diligencing who they're trading with and who they're buying and selling from, and there's AML requirements there. But more generally, that has reduced in part because it's not the easiest way to get away with something.
For sure. Last one for you. I heard that countries that are not great with the United States are heavily involved. So mining is controlled by China, or Russia is really interested in this, or some other country in the world that is trying to avoid sanctions, for example, etc. Why do I want to have something in my portfolio that is being used by someone who's not an ally of the United States in some cases?
That's an interesting question. I mean, I do think here it's a bit like oil, or even the dollar. It can be surveilled. It can be enforced on. The U.S. can extend its jurisdiction. You can limit the counterparties that you interact with to ones that are regulated. Ultimately, if somebody wants to take a $100 bill into North Korea, or if somebody uses oil to fund a terrorist effort. Or
my favorite is I think it was the drug office of the UK or something like that. They did a study, and Bloomberg published a big report that said $2 trillion of $2 trillion US dollars per year is money laundered.
Yeah, wow.
And when they started looking through it, they've got all the numbers, whatever. And you look at it and you're like, wait a minute, $2 trillion is laundered, and the entire crypto market cap is at the time was like 250 billion.
Yeah.
Right? So we're talking about literally 10x the entire market cap of all of crypto is being laundered in the legacy world.
I do think that, though, that the thing that, to many people, they're like, okay, fine, you've pointed out a blemish on the existing system, but we're in the existing system, so that's what it is. But I don't have to step into this new system, and if the new system is as bad as the existing system, why would I, So, but I think that the improvement in the new system is what we discussed, which is it's a transparent ledger. Everything that's taking place in the ledger, either now or in the future, can potentially be acted on, enforced on, and that is an advantage public blockchains have towards existing in compliance, existing in above board context. So the other one that you didn't ask that we get all the time, got today, is look, people say that this thing is scarce, but I hear that people just creating dozens of new Bitcoins. They're creating. There's hundreds of these Bitcoin things now.
Thousands. There's thousands of them.
Yeah, thousands. This is what
I went on CoinMarketCap. You see how many Bitcoins are on there?
Yeah. There's a bunch of them now. There's a ton of them now. What we try to articulate is, it's a little bit like saying, my uncle just launched a blog. Wikipedia's in trouble. Like there's something like 3 million apps on the App Store. People mostly use 10. There's like 350 million websites on the internet. People mostly only use Google, Amazon, Wikipedia, YouTube, Facebook. Because it's software, the marginal cost of creating a new one is de minimis. And so the same thing will happen with crypto. People are going to create new ones. That doesn't have any bearing on the reality of the existing ones. I think that the mental mode that one has to be in to understand. So there's two types of technology companies generally. One is Intel. They make some breakthrough in IP, and they figure out how to put more transistors on a smaller nanometer of silicon. They create like the world's first fabrication lab for doing that. And then they go to you and they say, would you like more speed for less money? And you go, dang, that sounds good. And that's the sort of IP hardcore technology type of tech company. There's another type of tech company, which is the Uber, Airbnb, WhatsApp, Facebooks, eBays of the world. There, it's not explicitly that they made some scientific breakthrough, but rather they've gathered a multi-sided marketplace that has sort of a centrifugal flywheel that causes it to just be superior. As a simple example, HP created WebOS, a mobile phone operating system. Great operating system.
Ever heard of it?
Yeah. What you have to imagine is, the consumer isn't going to buy it unless it has apps, and the app developer isn't going to write an app for it unless they're consumers. You and I could rewrite some of the Uber software, but the driver is not going to download the app unless they know they're going to get calls from riders, and the rider's not going to make calls unless the driver's on there. So similarly with public blockchains, they're not. I think that because it's so unfamiliar and there's so much jargon in crypto, people have an inclination to believe it's the Intel type of tech, which is like this patentable. It's not. It's a
network effect.
It's a network effect type of tech. It's the Uber type of tech. And so if somebody forks Bitcoin and makes some modification, or somebody writes a new protocol and expands on the prior art, you still have to go get all of the constituents. You have to get the miners, you have to get the app developers, you have to get somebody to create futures on top. You have to get the custodians to support it. You have to get people to actually want to buy it, and so that creates a lot of defensibility. So to summarize, like the App Store or the web, the mere creation of a new one
doesn't matter.
In of itself doesn't change anything, and the defensibility doesn't come from sort of novel IP. It comes from the network effect that emerges around the protocol.
Got it. Before we wrap up with our rapid fire, you guys are one of, I think, 2 or 3 now who have been slowly beating down the door for the Bitcoin ETF approval in the United States. Maybe just give us kind of a why are you guys interested in getting that approved? And then where do we stand today with the various applications?
So the why is 2 things. One, it's a very simple piece of infrastructure that that would simplify for a lot of investors getting access to the asset class. There are many investors who say, look, we're interested. We see it could do something in the portfolio, but we can't do it through these other structures. We use mutual funds. We use ETFs. This is going to be a 1% allocation. We're not going to rewrite our compliance manual. We're not going to rewrite our workflow. We're not going to hire this new personnel. We're not going to undertake a 2-week-long. It needs to slot in just like the same bar that we applied to everything else. So it's sort of a bridge that needs to be built for some people to come across. And that's a really big deal. The other, for some, there's some large institutions who said to us, hedge fund manager selection people who said, we'll probably first allocate to a Bitcoin ETF. I said, why? That's crazy. And he said, well, realistically, if a Bitcoin ETF launches, it means that the SEC did diligence on all of these aspects: custody, market manipulation, volume, pricing, and the exposure is enough for us. So but it'll be really valuable to have the SEC stamp on it. And so I think those are the 2 reasons that it's so high stakes. It opens up, a huge group of people who just can't walk across until that happens. And then the second is it does, and this is why it's such a big deal to the SEC, and they don't take it lightly. It does represent the SEC's done homework and said that this is feasible, and that matters to other investors. So where is the Bitcoin ETF journey at? The Winklevoss has kicked off the journey back in 2013 with the first filing. We're the
crazy, by the way, that's how early they started.
Incredible. Right. Yes, in some ways hard to imagine. And then our filing is the most recent. So our filing had a disapproval order in October, and then that was stayed. So the staff that works for the commission issues the disapproval order, and then the commission stayed the disapproval and is now examining it. So that's sort of the latest with Bitcoin ETFs is our filing and that. The backdrop, I would say, so this year we did it. We tried to contribute a huge amount to helping the SEC build their view and address the concerns they have. We wrote 500 pages of white paper. We went 8 times. There were over half a dozen industry constituents who wrote letters advocating for our filing and the ability to do this effectively today. That includes Coinbase, the Blockchain Association, a number of others. What we saw in their response was what we've experienced. I think what everyone understands by the SEC, which is they're paying attention, they're spending time on it, and they have a nuanced understanding, and they still have some concerns. There's not much more you can ask for from a regulator. Their job is to protect investors, and the gift that we all get as an industry is the fact that they've staffed people on this. It's a budget-constrained organization. People were furloughed at the beginning of this year when the government ran out of funding.
People forget.
Yeah. So the fact that they've even staffed people on this is a huge gift to crypto and obviously to the ETF efforts. And I feel grateful for the people internally at the SEC who are doing this work. It's not easy, but it's also not easy for a pension to allocate to crypto. And it's not easy for an endowment to decide to allocate to crypto. And so it's definitely not easy for the SEC to say we're comfortable with this, but they're moving along. So then the question is, okay, well, they've been moving along for a long time.
Yep.
Well, what should we make of this? And truthfully, I would like them to move faster, even though I really respect the work they're doing, because I think that this, for many investors, would save people from a lot of pain, a lot of harm, and a lot of the risks embedded in the other services that people are using, because they can't do it this way. And so they're sort of being, forced through omission, are being forced to the fringes of solutions. But you could say, okay, so they're spending time. What should we make of the journey here? Where are we in the journey? And here we like to provide as context. Matt, our head of research, one of the foremost experts on the ETFs, wrote the ETF section of the CFA, a great partner in educating on ETFs, leads our work on the ETF, points out that the first gold ETF took 2 to 3 years. The first fixed income took like 4, 5, 6 years. First leverage took 7 years. First non-transparent, which was just approved this year, took 9 years. Crypto is 5 to 6 years in, depending on how you count. For all these different novel structures, it's taken time. And so the question is not, will they disapprove this filing? The question is, is the thinking moving along? A devastating outcome would have been on the filing if they demanded that we withdraw it. If they said, do not make us write a public memo. Or because they don't want, they just don't care and they don't want to spend the time, right? Or another bad outcome would be if they wrote a 2-page memo. It says, not safe, it's manipulated, they didn't. They wrote 112 pages. When was the last time you wrote 112? I mean, you acutely know how long it takes to write things. Now imagine writing 112 pages and having 30 people weigh in on it.
About something that you don't care about.
Yeah, potentially. Yeah.
Right. Not going to happen.
Yeah. Right. And it's public precedent that you'll be asked about for the next 5 years. That's a huge undertaking. So why do you do that? You do that because you're working through a lot of issues and you want to communicate out. We're working. Help us solve these things. So we're grateful for that response. We think that the market would really benefit from something coming to market. We think that you can securely operate an ETF. Just to be very clear about that, we've been operating funds for 2 years. We believe that you can securely operate in the market. We've written a lot to that extent, and we're committed to seeing this thing through. So that's the latest on that. Yeah,
we're all cheering for you, man. Come on.
Thank you. I appreciate it. Yeah.
It's one of these things where I think that people will look back and say, oh, of course an ETF was going to get approved, right? and they'll kind of forget all the hard work that goes into it. So it's important to kind of talk about the hard work that goes into it.
I do think that's true. I mean, it took a little while to get bond ETFs approved. That's what I'm saying. I'm saying it took a while to get bond ETFs approved. And exactly to your point, you would say, what? There was a point where they didn't bond
of course
ETFs.
they were going to do that, right?
Yeah.
All right, rapid fire. Yeah. What's the most important company in crypto other than Bitwise?
It's I would say it's hands down Coinbase.
Why?
I think that Coinbase provides air cover for so many other companies in 2 ways. Number one, it demonstrates to capital allocators that you can build a giant business, a giant valuable business. And you need those tent poles, those success stories for people to fund new businesses. And I think that is sort of the shining example that people look at today and say, wow, I wish I'd invested in that business. And look, they've successfully built a giant business in this space. The second is that they're above board. They play by the rules. They interact proactively with regulators. They register. They get licenses, and they have massive scale. And so they're doing all of that with massive scale. And I think that is I think sometimes they're, like so many other things. Once it becomes familiar, start to take it for granted. Start to notice the things that we're frustrated with. But I think if you remove Coinbase from crypto, I think that on the regulatory front and on the private capitalization of new ventures, you lose a lot. So Coinbase, I would say, for those reasons.
What's the one regulation you would change or improve if you could?
Wow. Commissioner Clayton's looking at it, but I do think that there's this interesting aspect of the 33 Act, the Securities Act of 33, which divides the universe into accredited and non-accredited. And it defines accredited investors as having over $200,000 in income, over $1 million in net worth in 1933. Materially, what it means today, there's about 11 million accredited investors today, is really you have sort of like the people who can do what they want, and then you have everyone else. And as increasingly, this gets to a much bigger trend that's playing out right now. But in the year 2000, there were 8,500 publicly listed exchange-traded companies. Today, there's 3,500. The Wilshire 5,000 index does not have 5,000 companies in it. So companies are not listing. They're staying private for longer. The amount of time the average venture-backed company stays private has gone from 4.2 years to 5.5. They're getting their capital privately. They're staying private. People take them seriously privately. Nobody questions how serious Airbnb is because they're private.
Of course.
And so a lot more is happening in private markets, but private markets are only available to accredited investors. But Commissioner Clayton is specifically looking into this, which is how can we provide the protections that prevent people from losing their shirts, which are very important, and at the same time allow people access to the fact that a lot of value is shifting to these alternatives to private markets. So I think that's the one that feels to me like there's a sensible opportunity to improve. That's one that jumps out at me. I'm sure that there's a lot of others.
I agree. The accredited investor laws are a violation of the American dream, in my opinion.
Wow.
What's the most controversial
thing? That's a hot take right there, baby.
It's true.
Yeah. Well,
we wrote into law you have to be rich to get rich.
Ooh.
Right?
Yeah. There's definitely something to that. I mean, I think what has really become, in sharp relief over the last 20 years is there's two ways to make money. You can make money from capital and you can make money from labor. And they're two very different ways. They're taxed differently. There's two different tax codes for capital gains and versus labor wages.
Which one's more advantageous?
Yeah, right, exactly. And so times change, and I think that while maybe the mix of capital gains versus wage labor in the 30s was one thing, I think today it's...
What's the most important book you've ever read?
Oh, the most important book I've ever read. That's a great question.
All I do is great questions.
That's right. That's what I was just thinking. I was like, shit, how does he have so many great questions?
I've only done this 200 times. Go ahead.
Yeah, right.
Joe's laughing in the corner for everyone who didn't hear him.
Yeah. There's a
now his face is red. He's embarrassed that I called him out.
Yeah, now we're looking at Joe. He's been mostly laughing at my jokes though, as he promised to. Nothing. I'll tell you the book more recently. That's such a big question, and I love reading. There's so much opportunity. There's a book called Engines That Move Markets. Have you heard of that book?
Engines That Move Markets. I have not.
It's written by a former, I believe, CIO or chief economist for Franklin Templeton.
Okay.
Alistair Narn, I believe. Now I'm embarrassed to not have said it correctly, but it's called Engines That Move Markets, and it looks at some of the most important technological breakthroughs of the last 150 years through the lens of an investor who was there at the time. So it looks at the railroad, it looks at the electrical grid, it looks at the telegraph, it looks at the telephone, it looks at the automobile, it looks at the PC, and it looks at things like gross margins. Did the investors that backed these companies make money? Were the businesses profitable? Were there a bunch? Were there a few? Was it the first mover? Was it the incumbent? I think it most people are familiar with the stories of many of these different platforms, and some of the characters involved, Edison and the railroads, Rockefeller, et cetera. But they've never actually thought about it from the lens of allocating capital. Someone comes along and says, I have an idea for a telegraph that transmits voice, and I'm raising $100,000. There's a great quote from the CEO of Western Union who said, who turned down for $100,000 Alexander Graham Bell's offer to sell the patents. He said, what use does anyone have for a toy like this? And within 10 years, AT&T bought Western Union, which at the time had been the largest company in the country. So I think one of the reasons I love
crazy.
Yeah, it's totally crazy. I love history more generally. I had the opportunity to TA the history of business class at Wharton, and I love history, love business history. I love this book in particular because I think it just shows you the behind the scenes of how a lot that feels fixed in the world came into existence, and how uncertain it was, and the sort of arbitrariness of the path that things took. So I highly recommend that book.
Engines That Move Markets.
Engines That Move Markets.
Aliens, believer or non-believer?
Believer or non-believer? I think if I was betting money, that I would bet money on there being aliens.
Why?
There's two things I point to. Number one, humans always think that they know, and then they're always wrong. That is like the only thing that humans are consistently good at. The world is flat. Oh no, it's not.
Yeah, small detail.
Yeah. So yeah. We botched that one for a little while. Bloodletting cure for ailment. Oh no, actually not at all. So
there's 9 planets. Wait, nope. Now there's 1,400.
Yeah. So I default to unless there's strong evidence that something's not possible, I default to possible. What else? I mean, there's Fermi's paradox or Drake's equation.
So the reason why I asked this question is it started out as if aliens are real, so you have to just they're real.
Yeah.
Do they have pets, or are they all one single species and there's no concept of alien pets?
I love this question.
That's where that question came from originally. People forget. I used to ask every single person, do aliens have pets?
I mean, you would define the smallest unit. What is the minimal criteria at which you would consider something an alien?
This is your show. You define it however you want.
Oh, man. You're a pro. I imagine consciousness. Just anything with consciousness, regardless of form, size, something like that. Yeah.
That's fair.
And then, on a different planet. I mean, dude, they're definitely aliens. There's got to be aliens.
But are there alien pets?
I'm on the side of alien pets.
All right. So am I. Yeah. So am I. But I'm just that's my thing is if you've looked at all the movies, every sci-fi, there's no there might be aliens.
Maybe that's why they're always invading.
That are together.
They're sad. If they had dogs.
Well, here's a good one for you. Yeah. Do we want them to come in contact with us? In all of human history, the invaders have had a huge advantage.
No, 100%. I mean, I think they're no. Probably the answer is no. The answer realistically is no. And we're, it's actually interesting right now. There's sort of a burgeoning, private space sector that's emerging, commercialization of space undertakings. But you even simply you could see this through the lens of SpaceX and Blue Origin and Virgin Galactic, and these are private. And it's funny because in my mind there's some parallels to explorers in European explorers. If you imagine what Christopher Columbus or some of the other names for Francis Drake from that period were doing, they're going on very long journeys where you could easily die just in the process of getting in the direction of where you're going, and you don't know what's on the other side. And some of those journeys were financed privately by merchant banks and essentially wealthy families, but nobles. And it is kind of interesting to draw a parallel. The form has changed. It's not sailboats, but now it's rocket ships, and they're going. The journey is perilous today. It's being privately financed. The jurisdiction that countries have over where they're going is kind of unclear. So it's likely to be the Wild West in terms of how rule is enforced. Yeah.
Who gets to claim Mars first?
Right? Oh yeah.
You can get into all kinds of questions that I don't think people really want to know the answers to.
Yeah. Do you think in our lifetime, people are living either in space in some sort of on an international space station type. So obviously Virgin Galactic is pushing the frontier of space tourism. Do you think people are living in space or on another planet in our lifetime?
I think humans will make it there in our lifetime. Yeah. So I'm 31. I'm assuming you're similar, right? So let's say that we've got. Let's be real ambitious. Let's say we got 80 years in our life. So we got another 50.
Great. Yeah, average is 78.
Yeah,
all
right.
I'm
so,
optimistic. Yeah.
So perfect. Yeah. So we're
both going to get hit by a bus on the way out of this building.
Yeah, I'm not walking out with you.
Yeah. Joe's laughing.
Don't make Joe tell you about Cloacus luck. But no, so the long story. No, but if you think about that, so 50 years. We are 60 years, give or take, since man went to the moon. So the odds that we can get to Mars probably happens in our lifetime. I don't know if it is like true colonization. There's a difference between can we basically probe, or is it possible to get somewhere and then hey, are you sending your family, right? And the colonization I think is So that one's a little bit tougher for me to see that happening, but getting there I'm like pretty confident that we'll get there in a lifetime.
I'd love to know some of your other predictions about the future. Can I ask you 2 more questions?
Yeah. Well, actually, that's how we end. You get to ask me questions, so go ahead.
Great. Well, I've got a crypto question, but I want to ask you 2 other questions about the future. There's 170 odd countries today in the nation states. Do you think we have more or less than 100 by the end of your lifetime?
170.
There's 170 today. Mauritius is this island country.
Yeah.
Obviously.
So I've got a nuanced answer. I think that there will still be the quote country, but the definition of a country will change. And what I mean by that is it won't be so much tied to the physical borders of like, this is my land, get out. It'll be much more a group of people who choose to have themselves governed under a collective rule. Right, so like Estonia is a good example of this. Like all of a sudden, Estonia is taking citizenships from people who've never even been to Estonia.
Is that right?
Yeah, they've got like a digital citizenship.
Wow.
So like you could become a digital citizen of Estonia and never go within their physical borders.
Incredible. Yeah.
And so like I don't think that the country of Estonia goes away.
Yeah.
But all of a sudden, wait a minute, like their sovereignty and how they think about citizenship, like all that starts to shift.
Yeah.
The harder part is like, what does it become?
Yeah.
I'm not sure, but I do think that the idea of like what a country is changes.
Yeah. In that environment where you no longer have the physical constraint, which is you don't have to co-locate these people, but you just have to share a set of values or a set of standards. You would actually expect there to be more of these, right? Because the barrier to entry would be lower, and you could also potentially have multiple membership. I mean, that would depend, but you could actually see like. That's so interesting. That
California's going to be a country by like the next election, right?
I don't know about that.
Or what is it? Who's it? Tim Draper's got three countries coming out of California.
Yeah. That's right. Well, but that is.
But think about the internet. The internet's a country, right?
Yes,
like I think a lot about this idea of everyone is a citizen of the internet, and it's the largest country in the world.
Yep.
And there's some ramifications of the physical place in which you access the internet. But it's kind of like the Ready Player One. Like you go into the portal, right? And once you're in the portal, here we go, right? And so I think that is Twitter a digital country because it has its own fiefdom, its own rules. Everyone's a citizen. We all act along it. There's a quote unquote government, right? But it's Twitter censoring us and deplatforming and what.
Well, you could say the same thing about, so you have nation states. Then you could say the same thing about Islam or Judaism or Catholicism or, it's sort of an interesting spectrum there. But conventionally, the internet allows a long tail, a fragmentation to emerge. That's Uber allowed a long tail of people to become drivers. Airbnb a long tail of people to open hospitality. YouTube a long tail of talk shows, and WordPress a long tail of publications, Facebook a long tail of communities. So you could imagine sort of a long tail of more formal human organizations. There's a great article. Do you know Jesse Walden at Andreessen?
I know who he is. Yeah,
he wrote a great article on crypto networks as co-ops, as a digital way of instantiating a co-op. So Land O'Lakes is a co-op. There are a number of other co-ops sort of. Among us today, but the preferred way of organizing humans is a corporation or a limited partnership. But his argument is that a protocol is a way of forming a co-op, is shared set of rules.
You mentioned Airbnb. I'll give you a great quote somebody said to me. It said Airbnb is the largest hospitality school in the world.
Wow.
Because what they do, they taught people how to run hotels,
right? No kidding.
Or run rentals.
Yeah.
And they're usually people who had no formal training.
Yeah.
And Airbnb said, here's some best practices.
That's so fascinating.
Uber
kind of trained the labor force.
The largest taxi school in the world.
There's so many parallels. I mean, once upon a time, Ford in the early part of the 20th century, in 1918, had a school. There's a Ford school. Ford, by the way, also had a bank and also built housing.
Crazy.
And you had Ford Credit. There's a Ford store. So. It's so interesting. I mean, the reason I love business history is because nothing is new. Nothing is new. It just changes colors and it just changes clothes. But the idea that the way of conceptualizing Airbnb as both a labor training program as well as a business is a fascinating way of looking at it.
What other questions you got?
Another question I want to ask you. It was on the crypto front. And I was curious to ask you from your venture seat, how do you think about what are there particular pockets of crypto that are most interesting to you today? And has that changed over the last year?
Changes all the time.
Yeah, I'm sure it changes. I'm sure that changes all the time. And I remember there's a lot of enthusiasm for new protocols. Obviously, at one point, there's a lot of enthusiasm for custodians. At one point, I'm curious.
Yeah,
if there are themes there, or does it tend to be more?
So I tend to think of it as we've got some very core thesis. Those theses plays out in a lot of different ways. So two of the core, like probably the two core thesis we have is every stock, bond, currency, and commodity will be digitized over time. And the second is that humans will trust algorithms and software over other humans. So take the algorithms and software over other humans first. That plays out Bitcoin as a store of value. Like I trust that this software system is going to correctly store and secure my value for long periods of time. Okay. Well, then you can also go to, well, what about DeFi, right? There's a whole world there of me trusting software over humans, right? But again, to your point about like nothing's new. Well, like I trust Google Maps for directions. I don't trust the person on the street anymore, right? Like, 100%, like I'm going to ask somebody a question. Hey, do you know, how many World Series did the New York Yankees win? And you ask three people in New York, and literally you might get three different answers. Google, always right. And so it's like I trust that algorithm or that software. And so if you go down the line, I think that's like a really key theme, but it plays out in a lot of different ways. When you go to every stock, bond, currency, commodity gets digitized, that is playing out in people who are digitizing them, people who are providing custodianship for them, people who are providing marketplaces for them.
Building the infrastructure
like
for it.
You almost have to think of it as like the thesis is a bucket, and within those buckets are the applications or the execution of that idea. But one that I'm becoming much more, I think, excited about that people aren't talking about is using
until now.
It's using this technology, and this being decentralization, governance, etc., as the escape hatch for privacy and individual freedoms. So, like you were talking about earlier, governments historically have done nothing but continue to encroach on individual freedoms. Everything from simple things like there used to not be a federal income tax. It got introduced in a time of need, right? And it never went away.
I actually didn't know that. That's fascinating.
Things around surveillance state. You just why do we need that security camera on the
Patriot
street
Act.
corner? Now there's 20 of them, right? All that kind of stuff. So what ends up happening is there's usually pretty decent explanations as to why to do this at some point. It's just that the slippery slope is slippery, right? And you just don't go back. So the only way to go back or to reset or to give back freedom, it's not to argue with the government or fight the government, et cetera, because actually they're doing what the rational thing for a government to do is. They actually are trying to protect people. It's just that there's a balance between protection and freedom. What you have to do is you have to give people tools that they then opt into, right? And so if you look at like Bitcoin versus a central bank digital currency, there's going to be tons of people who use the central bank digital currency because it's easy, their government backs it, blah, 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 whatever. But then there's going to be a group of people who opt out of that system and opt into the more individual freedom, privacy type world. And so like, I don't know exactly how that plays out, but it's something that I'm starting to pay more attention to because it feels like it's applicable to money, it's applicable to surveillance, it's applicable to your data, it's applicable to the way that you interact with things, right? So, if we move to this automated world, and let's say that you're driving your car down the street and rather than pay your taxes, your car just pays for what it uses. So as you're just paying sensors along the way, well, like, who's getting that data, right? You could really quickly see this like kind of Orwellian, dystopian type world that I don't think is like 5 years away. But like if you walk backwards, let's say it takes 30 years to come. We're doing some things today that are going to accelerate us getting there. So I think that's a big one. And then the last one is this idea of the people who have nothing can leapfrog the people who have something. And so if you look at like mobile banking in like Eastern African countries, right? M-Pesa did a great job going from we have nothing to we have better mobile banking than most people in the U.S., right? And so like money's one thing, but there's a whole bunch of other things around technology. And you and I were both at Facebook around a time where like they were running out of users on the internet. Right. What do they do? Let's go give a bunch of people connectivity.
Even internet to everyone.
Yeah, like, you know, and let's go give internet to everyone. Well, now
time to increase the population of the world. We're gonna
So like now, as these technologies get built, whether it's a Bitcoin, whether it's you know, the financial services or protocols or whatever, they're going to be built and scaled on the back of that connectivity that didn't exist 20 years ago. So I actually think that companies can grow faster now. Right.
Oh, of course.
And they can become global from day one, because people forget already. You know, we talk about history of business. A company in the U.S. used to penetrate the U.S. market, and then let's have a board meeting. Should we have international expansion this year? Right. Well, now like you just turn a website on and bam, you're global.
Totally.
And so I think like those are all trends that come together. And then I'll kind of summarize it with one other piece I think is important is it's not just about blockchain or crypto. It's the melding of a lot of different technologies. So machine learning is not going to be siloed from a blockchain or from voice or from, you know, some other technology. It's really going to be the culmination of a lot of these, or the melding of them together. And if you go and you look at, you know, Amazon's a great example, Google's a great example, you know, even Facebook, etc. It wasn't just like, hey, I'm going to build this internet company. There was a whole bunch of other technologies that were all getting integrated with the quote internet that allowed some of those companies to be successful. And so I don't think that's going to change now either.
Wow. Do you think when do you think we'll see a country where people just start using maybe it's a stable coin, maybe it's some other coin, but you know, it's integrated into what they do? And
I think that we're going to see two different types of countries be the first. We're going to see like the China, the government is heavily incentivizing a little surveillance action going on, you know, this is good for you, wink, wink, stomp, stomp, you know, we're watching type thing. So I think that's going to be one attack vector to get there, which I think most people in the democratic kind of American values world disagrees with. But the other one is going to actually be the countries that have very innovative leadership, but realize they have very little to lose. And so you see like BVI recently tried to digitize or tokenize their currency. You've seen countries that are under heavy sanctions basically throw the Hail Mary. And so I think like that's the world where it goes back to, what is it, is it Jim Collins' book, Good to Great? Which basically, or I'm sorry, what's the saying? The good is the enemy of great. I'm sorry. So good is the enemy of great. And like if you think about the
great
U.S.
is the enemy of good.
No, good is the enemy of great.
Oh, okay.
So like the U.S. is good, but we don't have great payment infrastructure. We don't have great, you know, monetary policy, all this stuff. But it's good enough. It serves the purpose you and I need, right? It's worked for so long that we get complacent. Somebody who has nothing, who has no infrastructure, who has no, you know, discipline of monetary policy, etc., they are able to leapfrog us and become quote unquote great. But if you go back, the U.S. was great at one point, right? In the sense of when we came and the Industrial Revolution and all this stuff, like we leapfrogged others. And so it's this constant competition in a free market globally that we've got to remain, I think, vigilant. And Mark Yusko has this thing, and I'm going to mess up the numbers, but you'll get the general gist. For every one engineer that graduates in the United States, I think that there are 12 engineers that graduate in South Korea.
That's unbelievable.
But for every one lawyer they graduate, we graduate 45. Right? And and his point is, and again, those data points probably somebody's going to tweet me and say, hey, I got the data wrong. But that general trend, right? And the point of the story or the joke is they're a country of wealth creation, whereas we are starting to become a country of wealth redistribution, right? And I think that you know, it all goes back to this one point kind of in closing, which is I have the fortune to talk to a lot of investors, right? And investors that, frankly, one, shouldn't be in the same room as me, right? And two, that I admire because they're good at the thing that they do.
Yeah.
Right. And I'm usually there to try to convince them about Bitcoin or crypto or, whatever. But I always ask them one question.
Yeah.
And I say, what is the thing that separates the top 2 or 3 people in your strategy from the top 1%? So the absolute world-class best from the people who are really, really fucking good.
Yeah.
And historically, the most common answer is something to the effect of they cut their losers faster than everyone else and they press their winners harder than everyone else. Right? So pretty much strategy across the board that's common thread. Yeah. The second best answer, or the most common answer, has something to do with following demographics.
Wow. Yeah.
Which is very similar to the market conversation when you're building a company. Pick the right market.
Yeah.
Well, when you're investing, follow the demographics, pick the right market. And so I think that there's a lot of parallels there that just people forget, right? We all think we're smarter than we really are, all this kind of stuff. But when
it's
you
hidden in plain sight too, to some extent, demographics.
I mean, like, imagine if it's just, hey, I'm going to invest in the public equities in countries that have fast growth rates and young populations.
High skilled.
I have no clue what that's looked like over the last 50 years. My guess is it's probably performed pretty well.
Linear regression over the last 400 years of history, if you, either through subjects or population, had the most you generally did well. And I think we're about to see that with China. That was definitely the story with the U.S. It's easier to get per capita from 30,000 to 40,000 on a larger number of people.
Absolutely.
So I think demographics are huge.
So it makes sense.
Yeah.
All right, man. Listen, thank you so much for coming to do this.
Absolutely. This is really fun.
I'm a huge fan of what you guys are building. Obviously, we have invested. We are partners.
Thanks for being a great backer.
And everything. Where can people go find out more about Bitwise?
Bitwiseinvestments.com. Our Twitter is @BitwiseInvest.
Where can they find you?
I'm Hunter at bitwiseinvestments.com, and I'm at @HHorsley on Twitter.
HORSLEY.
SLE. Wow, that's extraordinary. You got that. People mess that up all the time.
Where do they switch the E and the L?
That's right. Yeah.
Yeah. Well, they just don't pay attention to detail
until now.
All right, man. Thanks so much.
Thank you. This is great.